So we are going live in 3, 2, 1.
Dear friends, wish you a very warm evening and welcome to the webinar for the launch of 361 Prime Limited's Maiden public issue of secured, rated, listed, redeemable, non-convertible debentures. I, Ajay Manglonia, representing GEM Financials, welcome all of you to this enriching session. Representing the company, we have with us Mr. Himanshu Jain, Whole-time Director and CEO, Mr. Sanjay Wadhwa, Chief Financial Officer, Mr. Neeraj Murarka, Chief Investment Officer, and Ms. Charu Kalita, Head Treasury and Fixed Income Trading. Just a brief introduction about the people from 361 Prime. Mr. Himanshu Jain, the whole-time Director and CEO, heads the lending solutions business and focused on growing the existing NBFC business, backed by his domain experience and business development focus. He has 2 decades of work experience across capital markets, wealth management, and lending business, including with Morgan Stanley, DSP Merrill Lynch, and Citibank, etc. Mr. Wadhwa, Chief Financial Officer, has more than 25 years of experience with an established track record of streamlining businesses and finance operations with wealth and expertise in finance across varied industries, including financial services, manufacturing, consulting, and audit. He was previously associated with L&T Financial Services, Reliance Mutual Fund, HSBC, ENY, etc. Mr. Neeraj Murarka, Chief Investment Officer, is responsible for the credit function, having more than 2 decades of experience in structured finance, corporate finance, project finance, M&A, etc. He focuses on driving non-sales functions, including credit, risk, treasury, operations, etc. Ms. Charu is Head of Treasury and Fixed Income Trading at 361. She has over 16 years of experience in financial market in end-to-end capital management and treasury management, with some of the largest corporates and NBFCs in India, including L&T Mutual Fund, Wipro, etc. 361 Prime operates as a lending vehicle of 361 Group. It is registered as a non-deposit taking middle layer NBFC. It is the wholly owned subsidiary of 361 Wealth and Asset Management Limited. 361 Wealth Asset Management is the holding company of 361 Group, with subsidiaries engaged in wealth and asset management services, including financial asset distribution, broking, lending, credit, and investment solutions, and asset and portfolio management. On the business front, company primarily provides loan against securities, loan against property, and unsecured lending products. It provides customized lending solutions, including financing against a combination of liquid and illiquid financial assets to meet all funding requirements of its clients in form of term loan and advances. With a seasoned board of directors and a highly professional, experienced, and skilled management team, we'll know more in detail about them in the upcoming presentation. The company has demonstrated sound operational and financial performance over the years, and its AUM has grown approximately 5,000 crore as on March 31st, 2023, from 3,700 crore on March 31st, 2021. In terms of disbursements, company experienced significant growth at a CAGR of approximately 61% from 6,800 crores as of March 31st, 2021 to 11,000 crore as on March 31st, 2023. As of September 30th, 2023, company reported nil NPA and maintained a capital adequacy ratio of 24.03%, which is significantly higher than RBI stipulated norms. Further, the company reported total revenue and profit after tax of 458 crores and 173 crores respectively for the half year ended September 30th, 2023. Company as the lending vehicle of 361 Group leverages the 361 Group's dominant position in wealth and asset management, industry to source and service its clients, which are predominantly ultra HNIs and HNIs. Now I draw attention to the structure of 361 Prime Limited, Maiden public issue of secured, rated, listed, redeemable, non-convertible debentures for the amount aggregating to 1,000 crore, with a base issue size of 200 crore and a green shoe option up to 800 crores, aggregating to the issue size to 1,000 crore. The tranche 1 issue is opening on Thursday, January 11, 2024 in this week, and is scheduled to close on Wednesday, January 24, 2024, with an option for an early closure anytime in this period once it gets the expected subscription, subject to minimum issue period of 3 working days. This is a tranche 1 issue, which is within the self-limit of 1,500 crores. Allotment shall be on the first come, first served basis. NCDs issued through this tranche 1 are rated CRISIL AA with stable outlook by CRISIL Rating Limited and ICRA AA with stable outlook by ICRA Ratings. There are total 8 series being offered in this tranche, including both monthly and annual interest payments option for 18 months, 24 months, 36 months, and 60 months tenors, which are the 4 categories of the tenors. The NCDs offer attractive coupons with in the range of 8.91% to 9.66% across 8 series. The issue structure provides for 30% allocation each to retail investors up to a 10 lakh rupee application size and high net worth individual above rupees 10 lakh application size, and 20% each of the corporate and institutional investors category, giving a primary preference to the individuals for subscription in this issue. The issue also provides option to retail individual investors bidding up to 5 lakh rupee apply through the UPI method. I earnestly appeal to all our partners to reach out to maximum number of investors in all categories and let them have this opportunity to invest in this attractive offering. On the second, may I now request Mr. Himanshu Jain to take us through the presentation and tell us more in detail about the business. Thank you.
Thank you, Ajay. It's been a very, very comprehensive and a generous introduction to all of us. And I think the way you have put a brief synopsis, I think you have covered all the aspects of it. But nonetheless, I'll try to deep down on some of the facets, which is the wealth management as a business. Second is NBFC as a business. And third thing is we'll touch upon on the public issue of NCDs. So that's largely is going to be the 3 parts that we will talk about. And in case if there are any questions, we will take it at the fag end. Please feel free to ask any queries as well. So thank you so much for having us for this nice audience where we can talk about us, about offering. And more importantly is more engagement. I think I wish things could have happened in person as well. But I think this digital mode works equally well. So quick about us. We've been a subset of overall wealth business, which is 360 ONE, which is a listed entity. It's been about 3 years journey. The business was started by 2 gentlemen, Karan and Yatin, the wealth business in 2008. So it was a startup, so-called. And since then, in about 15 years, we reached to a certain size and scale. Today, we are a dominant player on the wealth management side with the asset under management of about 4 lakh crore plus. And we are going strongly in terms of AUMs, in terms of new client acquisition as well. Total about 10,000 families we cover across 23 locations in India and 5 locations globally as well. We have about 225 bankers to not only do client coverage, but client servicing as well. And they've been all spread out across 15 odd centers. In terms of our cap table, we have leading investors, which is starting from Maiden, which holds about 24%, followed by Capital, followed by HSBC, IPRU, so on and so forth. I think the list is fairly long. Abacus has been a recent entrant, HSBC again a large stake. So about 70% of overall equity of listed entity, which is 360 ONE, is held by FIs and FI, and they've been there for a while as well. Market cap again is an output of the work that we put across. So it's always been hovering between 20 and 24,000 odd crores. That's what been the range in the last 1 odd years. In terms of PAT of the entire wealth journey, it's about 650 crores basis FY23 numbers. And we've been on a strong wicket for the current year as well. So that's about our parent, which is the promoter group, in terms of a brief introduction. Our 361 Prime, which is the NBFC vehicle, is a 100% subsidiary of the listed entity, which is 361 Wealth Management. If you look at in terms of our business, we do security-based lending, which means whatever we offer to our set of clients, which is wealth management portfolio, which largely include direct stocks, mutual funds, AIFs, alternatives, high yielding, high quality, high rated debt as well, against which we offer our funding facility to set of clients. Also, we offer funding facility against properties. So this is a second line of business. And third is there is a small portion in terms of unsecured loan. We will touch upon in terms of how exactly the entire process gets run. We've been in business for about 8 years as we speak. The AUM ranges between 4,500 crores to about 5,000 odd crores, basis the requirements of our clients. To support this, we have a net worth of about 1450 odd crores. And that puts us in a strong capital adequacy position of about 24%. Since inceptions, we've been about 20 odd percent. And that talks about that we've been on a very strong in terms of both the support in terms of equity capital, but also we've been relatively conservative in terms of growing our business as well. In terms of overall, our PAT, we half yearly based on 30th September, we closed at about 170 odd crores, and we are continuing largely the same run rate. And the significant line item that what we talk about is our strong liability mix, and which is fairly diversified in nature. I would touch upon some of the past as well. I think 2017-18, the IL&FS crisis was a wake-up call to the entire industry as well, where dependency was largely on the wholesale borrowing. I think subsequently, most NBFC, they have diversified. We also opened up and we changed our liability mix a fair bit. Today, our own wealth management clients and some of the institutions offer almost 50-60% of our existing liabilities through subscriptions or through participations to MLTs, market-linked debentures. That's been a fairly large size. Second is we have support from all the large AMCs that talks about commercial paper program. And third is, of course, the bank lines, which is there from top banks, which we'll talk about subsequent slides. So that talks about a very, very healthy mix across all three category of investors in terms of providing the liability. And that has helped in terms of running a very, very stable business across all the challenging period and times and being in business all this while. The other highlight that we intend to talk about is there's been a history of zero NPAs, and it's been the testimony of the overall business. And this is not only for the current financial year, but this is we are talking about day one of the inception of business. We have not lost a rupee, both on the principal and interest side. So that is a work, I would say, it's a difficult job. That's a work because of the prudence, because being circumspect, because being disciplined. I think all these combinations, they play out. And the final output is the credit rating agency's testimony. We enjoy AA, both at NBFC level and both for the public issue as well, in particular to the NCDs, and with a stable and with a positive outlook. So that's where we are as a firm. So these are the large, this is a high level dashboard. The next slide is more in terms of products that we do funding against. So these are largely large ticket transactions that we do. And the underlying product, underlying collateral is loan against security. Very simple. We don't try complicating things. So securities are simple, something which is listed and quoted on stock exchange. Either it is mutual fund units, or it's high quality debt instruments, or alternative asset class in terms of AIFs. This is largely our bread and butter business. And then on top, we have properties as well. If you look at just the loan against securities business, today, if we have a book of about, say, 4,000 odd crores against the overall book, We have an overall coverage of about 3x, which means about say 11.5 to 12,000 crores of underlying asset against which we have lent about say 4,000 odd crores. That talks about a fair bit of collateralization, over collateralization against these loans. And I think that's one of the important reasons that irrespective of the market volatility, we have come out without getting hurt in any manner, or we have come out absolutely clean. So that has helped tremendously. I think this is also a function of strong credit management practice. In terms of the residential apartments, which we all can relate with, or client offices in CBD areas or prime properties. Idea is that at any given point of time, considering the illiquidity in nature on real estate side, if push come to shove or situation arise, so we should be in a position to liquidate in case if client fails to fulfill any obligation, if situation turn really bad. So that's why we've been very, very conservative and restrictive when it comes to loan against property. Here also, we have about 2.5 times cover. Those in the real estate market can, or those who track real estate can fairly understand that something which is quoting at say about 50,000 rupees a square feet, on which you have if a cover of 2 or 2.25x, which means the value that you are taking for your loan is about 20 odd thousand as a break-even point. So that gives us sufficient cushion in terms of the comfort or in terms of the underlying collateral piece. In terms of unsecured loan, these are large wealth management clients, those who have been with us. So relationship aspect is a very important consideration when we offer these funding facility. We also look at the balance sheet strength. We also look at their past conduct. We also look at in terms of the end use of these proceeds. So just to give you an idea, I mean, unsecured loan has been of late widely spoken about, but in our case, these are all time-tested relationship, and we've been doing this business since 8 years. And in 8 years, if we have not lost any rupee, both on the principal and the interest side, that means we know how we manage even our unsecured loan book, because markets has gone through various different cycles. However, all our clients, they've been extremely kind and nice, and they fulfilled all their obligations. Charu, next slide, please. This is broadly in terms of how we stack up in the overall corp structure. And, to us, 361 Wealth, I think it's a great source. It's a great support that we have. And we've been extremely lucky and blessed as an NBFC, as a management team here, that today we have about a franchise which has about 10,000 strong clients, presence in almost about 50 odd cities. In terms of client base, I'm talking about where we have about 225 bankers, those who are doing client coverage. They've been very, very, these are very strong point in terms of lead generation, in terms of getting new business on board. Also, NBFC has its own sales team. So they also work on the references they get in terms of initiating any fresh business. So that's been the fruits that we get benefited out of 361 Wealth Management as a business outfit. In terms of the quality of business, I would say that there are two important parameters that one should judge any NBFC business. One is in terms of the overall obligation towards your lenders. In 8 years, we have never, in fact, delayed even by a day any of our liabilities which have come for maturity or rollover. We have fulfilled every single obligation. And second side is in terms of all our clients, those who have borrowed our money, they have fulfilled all their obligations, both on the interest servicing and principal repayment. So these two aspects in terms of zero NPAs, and second is we in turn fulfilling all our obligations on terms of our liability providers. I think that talks about the robustness of the business, and that talks about how we've been prudent in terms of building this business block by block. On the team, again, Ajay has done a generous introduction, but nonetheless, Neeraj and I started this business together way back in 2015, and the entire management team we have not lost a single person in our team size. And that talks about in terms of the stickiness, because again, as I said, these are large ticket transactions, very personal, very, I would say from a relationship point of view, are extremely important. And we've been very, very lucky considering the overall attrition in rest of the financial services and NBFC vertical. We kept our talent pool together. And each one of us, we come with our own set of with experience, both on the wealth management side, both on the NBFC side, and in terms of the corporate functions as well, where we have seen a fair bit of different industry exposure as well. Some of the big names, Neeraj has spent time with HCL Tech, Sanjay has spent time with L&T Finance for a long period of time. My colleague Charu has spent time with Piramal, marquee names, and gone through fair bit of work, and they've all grown within those organizations by sheer their work and their deliverables as well. So this entire team works very, very closely with the bankers, with the clients, and making sure that whatever we are doing as a business, that is all getting reflected in our scorecard. Capitalization, we have already spoken about. Unlike many NBFCs, those who run bit on thin liquidity, we have always carried excess liquidity to face any untoward situation as well in the market. And the capital adequacy ratio of 22% plus, with a capitalization with a net worth of about 1450 odd crores, that augurs very well with the overall balance sheet size of about 7,000 crores. In terms of technology, we take a lot of pride in saying that we build our own technology. It's a completely green field built block by block. There are many solutions with our off the shelf which are available, the loan management system. However, we chose to do things basis our own requirements. And today, after 7 years, we can say that our technology solution is possibly the best. And we have looked around all the other loan management systems which are available off the shelf. And this is one comprehensive package which gives you not only flexibility on the client onboarding side, but also the posting, the perfection, the integration with depository, the interest calculation, the maturity profiling, in terms of tracking margin calls, in terms of throwing data out, in terms of margin calls issues as well. So it's one integrated system which takes care and which has made our life extremely easy in terms of data and data analytics as well. And in case if we take pride in saying repeatedly that we maintain a zero NPA, I think technology has played a very, very important role in terms of giving timely alerts and data points as well. Risk management practice, this business is all about discipline. That's what Ajay started with, and we enforce that. It's because, as I said, the overall volatility in capital market has a reflection on the prospect of this business, and you have to be always on high guard and alert in case if you spot any symptom of any volatility, because you have to go back and just check your underlying portfolios as well, how the volatility has impacted some of the portfolios, and accordingly you have to respond to those situations as well. So in brief, the essence of this slide is the corporate, which is us, which is 361 Prime, and the benefits that because of strong parentage, the experienced team, the asset quality that what we have built, the way we have run the treasury operations, and the risk management practice, including the technology setup, I think it has helped in terms of the way we have overall delivered so far in terms of business dashboard. Charu? Yeah. Quick in terms of business performance. Again, we have kind of touched upon in bits and pieces in my previous slides as well. So total loan book that we talk about is between 4,500-5,000 odd crores. These are end of period number that what we see. So typically there are spikes at the times end of the quarter as well, especially 31st March and 30th September. But steady state, we've been on the north curve in terms of building our book gradually, organically. So that's been the mandate, and that's what we've been doing. In terms of overall yield, if you look at we are at about 11 north of 11 quarter plus, and if you look at in terms of year on year, there is a bit of jump as well. It's all about the high quality work which is being done by the treasury team to raise high cost effective resources. Also, the sales team in terms of lending resources prudently and making sure that we make enough money. Just to give you an idea, I think that will also be comforting to your audience and to your client base, Ajay, is that we are not in the category of mid-teens or high teens kind of loans, where there is a different ball game altogether, different approach altogether. We've been very conservative and we've been extremely disciplined, and that is getting reflected even on overall yields that which is there at a book level. The capital adequacy ratio, as I said, from very beginning, we've been about 20% plus category. Exception was 23 for two reasons. One, we certainly aggregated a lot of assets. We increased our loan book size by about 1,000 odd crores. That's the reason the capital adequacy dropped by just below about 20 odd percent, which has been fairly consistent. But again, as I said, we have enough profit post distribution of dividend that retained earning helps us in terms of gradually increasing our net worth. And then we are back in FY first half of 24 that we are maintaining at about 23% plus. In terms of borrowing cost, again, if you see, I think if you see bottom two boxes on the left hand side, I think this is the entire summary of our business. One side on the yields, it's just going up, and the borrowing cost is coming down, and that talks about the increase in profitability. And we've been maintaining that trend. The only exception is that you see in FY22, whereby suddenly there was a spike about 90 odd crores we booked basis M2M of the investment portfolio. So that was one time. Otherwise, it's always been a very steady state in terms of profitability as well. Charu. Okay, this is largely we have touched upon that basis security, almost 89%, 88-89% is your fully collateralized book, and about 10-11% is the unsecured loan. And we have said that we have very high degree of confidence and comfort with clients where we have lent unsecured loans. Again, there is a fair bit of discipline that what we observe. So there are CIBIL checks, there are the balance sheet strength, the relationship aspect, the wealth management portfolios, the end use of funds, because essentially if client is borrowing, they have to fulfill their obligation on the interest servicing and the repayment. And idea is when the money is being productively used, chances of getting your repayment is high. And that's what we do when whatever underwriting we do, both for secured loans and unsecured loans as well. And that's been, again, if you look at in terms of our overall LTV basis on the secured loans, it's almost 3x on the loan against securities, which is, again, as I said, I am being repetitive. You have direct stocks, you have high quality debentures and bonds, then you have alternatives, and you have mutual funds. So that's what's the securities composition. Property, we have already spoken about. Still, it carries about 2.5 kind of cover, which is extremely comforting. And at times, it's a hybrid portfolio, which client posts, where it has a combination of both securities and real estate put together. And in turn, they increase their overall borrowing capabilities by posting both the collateral as well. Next slide, please. In terms of liability mix, which I just kind of initially touched upon, we came a long way in the last 5-6 years, and the entire NBFC, for that matter, the entire NBFC world, the dependence on the overall wholesale borrowing has come down. And idea is more that to open up and to make sure that you have diversified pool of liabilities provider. So it was just the dependency largely was on the mutual funds to give us CPs. Over a period of time, we have included our own clients on the wealth side and some of the institutions who subscribe to our market-linked debenture program. Also, some of the banks, some of the large names which are there, starting from State Bank, ICICI, HDFC, and Karnataka Bank, they've been extremely supportive in terms of offering facilities, loan facilities to us. And on the AMC side, starting from iPru, UTI, Tata, Nippon, ACT, they've been kind of always been giving us support as and when we need in terms of providing a CP. And now we are opening up and we are coming out with this public issue of NCDs, which we are sure that there is going to be a fair bit of retail participation. So there is another line of, I would say, our clients on the liability side, which will join us in the family and make it a fairly diversified pool and making it far more robust as well. So in terms where we were about 5 years back to where we are now, instead of just heavily dependent for CP, today now already we have three strong, I would say, liability, three distinct client, those who are providing liabilities. And now the fourth would be the public issue, whereby we expect a fair bit of retail traction to come up, and that will even make, will further strengthen our overall liability profile. This is again one of a slide where we take a lot of pride. It is all about talking about the ALM and the positive ALM that we run across categories, starting from short term, which is as low as 7 days, to go as high as about 5 years. Across categories, if you see, across maturity profile, we are maintaining positive ALM, whereby we always carry excess liquidity. We always have the contractual obligations are always being long dated over the corresponding liabilities, corresponding asset. And that has helped us in terms of making sure that in no bucket we don't have a positive ALM. Risk management, I think that's what we, as a business, we have to practice day in, day out. From a credit risk management, I think I've already kind of touched upon all our portfolios which have either daily NAVs coming in or which have underlined as direct stocks. It all gets updated on daily basis. I mean, word from day one, we update our portfolios on daily basis, where we are getting market data both for listed shares and NAVs. Wherever things are coming on periodic basis, we do it. So that talks about our collateral management. In terms of stress testing of portfolios, we do it very often. And in terms of doing health code check of our existing client as well, we update CIBIL, we update their financial statements basis end of financial year as well. And idea is that's always been an ongoing work, not only for the existing set of clients, but also for the new set of clients also. The rigor continues in terms of doing the KYC aspect part of it. This is only the financial aspect, but even on the AML checks, etc., whatever is being prescribed by a central bank as a minimum expectation, we do everything, whatever is required, and even more for that point of view. Plus, more or less, our clients or large pool of our clients come from wealth management. So at a certain level, the KYC is already done. We just redo, we always refresh the same KYC, and we do, of course, independent checks and balances at our end as well. Market risk management, again, the environment that we are in middle of, we have to be sensitive about interest rate. We have to be sensitive about our people. We have to be sensitive about in terms of third parties. So there is a long list. There is a full-time chief risk officer, comes with about 20-25 years of experience. Again, directly works with the board. We have a policy basis which he updates to the board in terms of the entire portfolio, how he feels, and the associated risk basis about 10-12 parameters. So that's been extremely well managed thereout. In terms of liquidity risk, I think that's what the entire treasury teams, they do day in, day out. The last slide talks about positive ALM across all buckets. I think that's the testimony of that. In terms of business strategy and forecast, we've been told in terms of be very, very cautious and circumspect making forward statements. So we will continue with whatever is stated in terms of the document. But idea is wealth as an opportunity, because directly and indirectly our fortunes are linked with the overall prospect of the wealth management business as a whole. So we are at about 4 lakh crores, whereas loan book is just about 10 below about 5,000 odd crores, which means we are just about 1.25% of overall AUM that we have on the wealth side. Just to give you global benchmarks, starting from UBS, Citi, Morgan, Merrill, Barclays, Deutsche, JB, any of these names, I think they have about 8 to 10% of their asset as a leverage assets. So they offer through banks. We here have a distinct model, which is NBFC. That's how we do our business. And that's how it talks about the overall opportunity which exists. In terms of sourcing business, of course, we have about these dynamic 225 bankers, those who've been always look out for any business opportunity on the NBFC side. They do that introduction. We have our own team on the NBFC side. They've been well entrenched with various market players as well, keep getting references, and they've been very active in terms of seizing any moments on the business side. So opportunity and the runway is long for us. And honestly, we have just scratched the surface from a point of view of overall business, because idea is we've been relatively conservative in the start of the business, making sure that in case if market circumstances become choppy, we should be in a position to fulfill all our obligations. So that's how this business has been built so far. And that's how this entire quality which we have delivered is basis being relatively conservative and not too aggressive. And that is reflected even our capital adequacy ratio as well. Platform technology, we have widely spoken about. That's the essence of entire 361 Wealth. We've been always forefront in terms of embracing anything which is happening, both the digital world and updating ourselves as and when it requires. Again, loan management system, I've already touched upon. It's all homegrown, and it helps us in terms of having a data which is as good as live. And it also helps in terms of making sure that we manage any situation proactively instead of being reactive. In terms of borrowing cost, we've been in a overall last 18 months been hardening of interest rates, which we have seen. We've been extremely lucky and fortunate that we carried some of the old, I would say the past liabilities as well, which helped us in terms of having resources at about 8% odd. But over a period of time, the same liability mix will go for repricing as well. But still, we are in a good shape because one, the diversity of overall liability providers. Second is all the buckets are largely equal. So there is nothing which is lopsided in nature. And that's the reason the diversity is only going to help us going forward. Balance sheet numbers, Neeraj, if you want to touch upon.
Yeah, so all the balance sheet numbers. Yeah, all the balance sheet numbers are in front of the screen. Like any other financial institutions, we have hardly any investment into the fixed assets. Most of our asset size is either the loan book or the investment book. And if you see the investment book apart from the loan book, so investment book has mainly two constituents. One is the regular treasury management related investments, which is say liquid fund, GSEC, etc. And the another investment which we have is the AIF book, which we work as a sponsor on behalf of our parent entity to structure various AIF, which we distribute to our clients. So we subscribe to the sponsor class. So approximately 900 odd crores are invested into the AIF. And apart from the 900 crore, we have 1000 crore odd into the various other investments, which are largely liquid in nature. On the liability side, our liability is largely contributed by the debt securities, which is either the MLD or the NCDs. And apart from the debt securities, which we have the bank loan, which constitutes most of our liability apart from the share capital. I'm happy to take any questions if it comes on the balance sheet side. We can move to the next slide. On the next slide, we have projected or rather given the numbers, historical financial numbers. I mean, for the current financial year, we are already on track. For the first half year, our PAT number is 173 crore against the last year full PAT of 235 crore. Next slide.
Okay. This is talking about So this is talking. Okay. Am I audible, Ajay? Thank you. So this is talking about, Yeah, thank you so much. This is talking about the management team. Again, Ajay has already done the introduction, but nonetheless, uh, to my left is Sanjay, who's been a CFO. And again, left to him is Neeraj, who's been a CIO looking after Treasury Credit. And to my right is Charu, who's been head of Treasury. So this is core to overall 361 Prime is concerned. And then we have our founders on the wealth side. Karan needs no introduction. He's been a stalwart and mascot of overall wealth management as an industry. And he has complete involvement when it comes to overall NBFC business is concerned. He's being well supported by Yatin, who's been a co-founder of Wealth Business as well. He also gets into in terms of all the client loans and how exactly the entire underwriting process gets run. So again, fairly well-experienced team. Each one of us, we have about 20 years plus experience in terms of wealth, in terms of lending, in terms of overall the entire capital market journey. So that's about us. If we look at our board composition, it's been we've been one of those fortunate ones in terms of very active and proactive, in fact, involvement from some of the board members as well. Dr. Narayanan, he's senior bureaucrat, about 40 years of career. In his last assignment, he was advisor to Prime Minister's office. Also, he played a significant role in terms of framing policies and in Ministry of Finance, also in Ministry of Petroleum and Gas. And he's somebody who's our conscious keeper in terms of having a complete oversight. Mrs. Rekha Warrior with us for about 4 years plus. She was with the Reserve Bank of India with almost 3 decades in terms of policy framing. The entire GSEC framework was her credit, along with her team members then. And she's been helping us in terms of making sure that all the policy framework, etc., whatever is being expected, we do a better job there out. Ms. Revati, she's been with us for almost just been a new induct with us. And she comes with a very, very strong CV value, which is there. Karan, I've already spoken about. Yatin, I've already spoken about. So that's about the board of directors. I've been already advised on the time check, so I'll be relatively prudent in terms of timing aspect, because I'm sure Ajay and his clients will have some of the queries, so that can be taken and appropriately addressed. So public issue, again, it is more in terms of, as we have said, beefing up of our capital, of our liability structure. This is issues base size of about 200 crores, of 200 crores with a green shoe option of 800 crores. So total, we intend to raise 1,000 crores. So that's opening on 11th, which is Thursday. Mandatorily, we have to keep it open for 3 days, but issue is always first come, first serve. So that's been always been the case. I don't know, screen got changed. So anyway, nonetheless, doesn't matter. We've been rated by both CRISIL and ICRA as AA with stable outlook. These are secured, rated, redeemable, listed NCDs with a face value of 1,000. And the subscribers can subscribe in multiple of 10, which means the minimum ticket size, minimum application size has to be of 10,000 rupees, and thereon in multiple of 1,000. And in terms of allocation, we start with the retail category of about 30%, which is about up to 10 lakh application, which gets classified in this category. Anything about 10 lakhs and plus in individual category, which is we call it a HNI, which is again a 30% allocation, and both institutional and non-institutional side 20% each. So that talks about the overall category of investor through which the funding, through which this entire offering is being proposed, and they will participate basis the category that they fulfill basis their KYC. In terms of the coupon and the tenor.
Is it not visible? Our screen is not visible.
How do you zero? This is some query which has come up. Fair enough.
Last slide. So it's
Just the issue
Okay.
structure.
So important from an issue structuring point of view. So basis client needs, we have coupon payment basis monthly and yearly as well, and basis their own requirements as well. We have various buckets starting from 18 months to about 5 years. So basis individuals or corporates or institutions, the way if they feel comfortable, they can subscribe. Various options being given. These are, as I said, these are all secured by 1.05 of X of receivables, which is principal plus accrued put together. And there is no put and call option. So which means if we are contracted this liability, we will make sure that, yes, we fulfill these to the corresponding tenor. Also, they are going to get listed on the WDM side of BSE. So in case anybody post allotment, post listing wants to trade, there is always a window to trade as well. So that's in summary, Ajay. Please feel free to ask any questions. In case you already have those questions, you can ask. Or if any of your client directly wants to check with us, happy to address any of those queries, both from Well Business, NBFC business, and the overall public issue.
Sure. Thank you, Himanshu. And we'll now open the floor for the questions. We see some questions, and team will start displaying those questions. The first question is from my audience. How do you manage zero NPA company when the entire NBFC universe across the asset class have NPAs, especially unsecured assets? I think we have a very low unsecured assets, but you can put in more light to it, Himanshu.
So, it is all about being prudent and disciplined. I think that's to us is the most important thing that we practice every single day. And when we talk about prudence and discipline, idea is that anything which doesn't meet our own first feel, first check, we believe in saying no. So idea is that as a NBFC, the board has clearly mandated us that you are not supposed to take any extra risk, or you are not supposed to take chances around it. So that mandate was very clear and well, imbibed by the entire management team as a whole. So that's the starting point. Once client gets onboarded, we set the expectations right in the beginning itself that yes, all margin obligations resulting out of any market movement, etc., that needs to be fulfilled basis whatever the number of days which is being prescribed by central bank now, about 7 days. But we've been very, very forthcoming and very disciplined in terms of reaching out to our clients in case if there are any margin calls. Third, we've been not in a trajectory whereby we are dealing with about mid-teens client or higher teen clients as well when it comes to overall rate of interest are concerned. We managed at about, say, 12-ish, 11.5, 12-ish kind of category. And that prudence help us in terms of maintaining our NPAs as well. And finally, the technology, which I've been kind of spoken about, and the experience that we all bring on the table from our past assignments, plus what we have seen in the industry, various cycles as well. I think this is a combination of all these factors that in last 8 years, we have not lost a rupee. With the regulatory guidelines on NBFC, how is 361 handling the liability side? Can I turn it to my colleague Neeraj?
So I'm not too sure what is exactly expected from us.
Yeah.
If some more details, then it will give us more clarity to answer which regulatory guidelines is being referred here.
So, Neeraj, I think people are talking about the recent regulatory guidelines about extra provisioning for the unsecured loans, and some of the guidance by the RBI about the AIF investments.
Sure.
They are the two things which are restricted.
So on the extra provisioning, so largely if you see the RBI circular, it is more intended towards the consumption-based loans. I mean, whether it's the unsecured or secured loan. Whereas whatever loan we are giving, these are not the end use is not the consumption. The end use is either to make the investments or to invest into the business or to exercise their ESOPs. So these kind of end use are there. So we are largely not impacted by the RBI recent regulatory changes on the provisioning of the unsecured loans. Coming back to the AIF related exposure. So largely if we see the RBI circular on the is talking about the common exposure which is there from the NBFC and through the AIF investments. So hardly we have some AIF investments where we have the common exposure, and that too largely into the equity in nature. So we are getting a message that probably the equity exposures where we have the commonality may get excluded by the RBI. Even if it is not, still we are confident that we'll be able to liquidate those kind of equity related exposures from our own balance sheet. So we don't expect any extra provision getting created because of this RBI new AIF related regulations.
Sanjay, you want to supplement anything?
No, I think Neeraj just
okay. Okay. Ajay, your next query, please.
The next question is about what will be the 361 Prime Limited strategy to compete with increasing competition. I think people are referring to a lot of new NBFC which are upcoming in the time to come. How is the competition? I think it's an easy answer.
So competition has been there from day one. It's not something that we are going to face competition now. That's one. Second is most of the competition which is coming through fintech is more on the retail side. We are more on the wholesale side, large ticket loans as well. So there anyway, we have a distinct advantage basis our wealth relationship. I think that to us is the key, I would say, a differentiator. Second is in terms of the underwriting practice. And third is the speed. I think we thrive when it comes to delivering solution to our set of clients. And we have delivered fairly large ticket size in about a week's time. And that's where we bring that differentiating approach for clients, those who have certain time sensitivity. Structuring skills, again, considering our background, considering the way we've been kind of exposed to, that's again something where we take a lot of pride in talking about. So these are some of the factors which helps us for us to be ahead of competition. And again, it's not about just at what price that you are cutting transactions. It's all about the timeliness. It's all about good hygiene. It's all about that the kind of flexibility that you are giving it to your borrowers. I think that's something which is a key differentiator, just not about the pricing.
Great. Any more questions? I think we have a couple of more. The next question is about the finance industry is becoming increasingly competitive. So what is the strategy do you have in your mind about the company's future growth? It's not about competition, but it's about the growth. The second one attached to this is, do you plan to introduce new products and services for the customers in future in the adjacent spaces?
So, I'll take the second one, which is a relatively easy question for us. And I started with our wealth franchise, and I've spoken about the AUMs. Idea is we have just not even about 1% of overall AUM, which means we have a long way to go. That itself is a huge opportunity for us in terms of building up our loan book. Second is from a wealth point of view, it's something which comes naturally, whatever is there on the wealth platform in terms of product offering. We look at all of them and selectively we offer funding facilities against them. The property angle, which we kind of now off late, we've been, I would say, relatively aggressive on that. That's again going to be a center focus for each one of us here. And that also has a long way to go. Minded for small loans against properties or mortgages or primary mortgages, there is enough competition there out. But when you talk about big tickets loans as well, especially on property side, you won't find too much of competition there. And that's a clear differentiator. Plus also we do hybrid portfolios, which is a mix of properties plus the financial portfolios. I think that some of these things can easily take us for at least next 3 to 4 years. But we've been as we've been always been alert, and in case if we see any opportunities where we have to come up with new ideas or new products as well, we will always be vigilant around it, and need based whatever suits our client and our DNA of wealth, will make sure that it's there on the platter.
I think by and large you addressed the first question as well. The next one is about what. Next one is about LAS is considered as a risky segment. How do you ensure that the risk associated with the asset class is managed well? I think it refers to about the volatility in the stock market, though since last couple of months and years we have been seeing a bull run.
So all I can tell you is last 8 years, business has gone through various cycles. We have seen the entire NBFC meltdown, I would say, of 2017. We have seen the entire COVID phase of 2020, where market really came off big time and corrected as well. We have seen mid-cap correction of 2021 as well. So idea is, as and when there is always been some event with a certain periodic intervals, and they have always thrown some new challenges for us. So risk is something which is, I would say, an inherent characteristics for each one of us to be careful, prudent, disciplined, and making sure that yes, anything which is coming on the table, that's been well addressed and proactively dealt with. And just for everybody's reference, and I missed out touching upon today, is people may say this is extremely a risky segment as well. For us in 8 years, if we have not had any bad incident of both NPS and not a single open litigation. And to us, I think we take a lot of pride in talking about this. That also talks about in terms of our onboarding process of our clients as well. So idea is risk you manage through two ways: when you select your clients. Second is when you onboard them, and when you look at once the relationship is established and when you look at their portfolio and the discipline around it. I think this is both ways. You have to be always on toes in managing these two facets. So I won't say this is less risky or this is more risky. It is all about the way we conduct and being repetitive, the discipline that we follow in running our business on day-to-day basis.
Perfect. So being disciplined and kind of having zero litigation and zero NPA is a remarkable achievement, I would say. And with all of that, I think we have done with the questions, and as such, I think we now.
Thank you, Ajay.
And dear friends, as we have heard and seen the attractiveness in the offering of the 361 Prime public issue of NCDs, may I now request you to support us all heartedly by reaching out to all the segments of the investors class, especially the retail ones where we have more reservation. You may reach out to the issuer, lead managers, or consortium members for any further information or clarification in case you need. To reiterate the issue details once in brief, it's a 1,000 crore tranche fund issue with a base issue size of 200 crores and 800 crores green shoe option. It's opening on this week, Thursday, January 11th, 2024, and is scheduled to close on Wednesday, January 24, 2024, with an option to early close once we get the desired subscription and giving it a day's notice, but the issue minimum running for 3 days. Allotment is always first come, first served basis and debt issuances. There are total 8 series being offered, including both monthly and annual interest payment options for a tenor of 1.5 years, 2 years, 3 years, and 5 years. The NCDs offer attractive coupons yielding in the range of 9.27% to 9.66% yield. 30% of the issue size of each are allocated to retail and HNI, and 20% each is reserved for corporate and institutional investors. I thank you all for taking time out to attend this session today. We shall look forward to your wholehearted support as it has always been the case. That's all. Thank you.
Thank you. Thank you so much.
Thank you.
Thanks a lot.